Cities around the world, in particular ones in the emerging markets, are on the front line of financial resilience challenges as well as climate challenges. These include liquidity challenge on an immediate basis for response, a lack of financing in relation to climate risk, and the existing fiscal constraints that hinder investments in pre-disaster preparation measures such as insurance products. The Climate Insurance Linked Resilient Infrastructure Finance Facility is an initiative promoted by the UN Capital Development Fund and in conjunction with partners across the public and private sector. CILRIF is aimed at enhancing climate resilience in developing countries through the design of novel long-term climate insurance product linked to financing for resilient infrastructure development. Funded by KfW and implemented by ICLEI, the Urban Infrastructure Insurance Facility aims to provide insurance solutions for critical infrastructure and 7.5 million people living in 10 cities across the Latin America and Caribbean region. By 2025, selected cities will undergo a risk assessment of their critical assets and areas, which informs and tailors insurance coverage products to their specific needs. By engaging with other cities and relevant stakeholders to introduce different approaches relating to insurance solutions, participants will leave this session with an understanding of the importance of diversified risk management mechanism and their long-termism objectives. Before we deep dive into these two initiatives, it is my pleasure to introduce you our speakers and facilitators. The facilitator for UIIF breakout session is Anina Hartung. She's the junior officer at ICLEI World Secretariat based out of Goa. She's with the Resilient Development Team at ICLEI, a World Secretariat who contributes to ICLEI's Resilient Development Pathway, connecting opportunities to subnational governments on a diverse range of topics. In particular, she supports the global coordination between ICLEI's 24 global offices under this pathway, along with contributing to the UIIF project. She has an academic background in interdisciplinary environmental studies and holds an MSc in environmental governance from the University of Freiburg. Next, we have Maxime Sauvinet, who is the analytics team lead at UNIIF based out of Bonn. Dr. Maxime Sauvinet is French-German and is the analytics team lead and senior scientist at UNIIF. He also worked as a postdoctoral scientist at the University of Bristol, UK, and worked for 3 years as an international consultant for GFA in Hamburg for different donors from international donor landscapes such as KfW, World Bank, and GIZ. He holds a PhD in hydrology and climatology, MSc in natural resource management, and a mechanical engineering degree. He has more than 15 years of international research and project experience in climate risk modeling, disaster risk, natural resource management, and climate change adaptation. After that, we have Ms. Merlina G. Panganiban. She's City Urban Development Officer for the Government of Makati. She's an industrial engineer with a PhD in urban and regional planning and a certified environment planner. She's a dedicated public servant for more than 35 years, specializing in the area of urban planning and development, information technology, and geographical information systems. We have Adam Sobel, who is a professor at Columbia University in New York. Adam is a professor of applied physics and applied mathematics and earth and environmental science at Columbia University. He directs its initiative on extreme weather and climate. His research area is meteorology with a focus on atmospheric and climate dynamics, tropical meteorology, and extreme weather. Then we have Sam Lynch, who is a program coordinator for Miyamoto International based out of Washington, D.C. He's a program coordinator focusing on affordable housing, climate resilience, and disaster risk management. He provides research analysis and project management support to donor-funded projects across Africa, Asia, Latin America, and the Caribbean. Through his work, Sam advocates for sustainable urban development and resilient construction. Then we have Stephen Liberator. He is the head of ESG Impact, Global Fixed Income at Nuveen. He is the lead portfolio manager for Nuveen's fixed income strategy that incorporate ESG criteria and impact investments, including those that comprise core impact bond, short duration impact bond, and green bond composites. He is also a member of the investment committee. He has served on the ICMA Green Bond Principles Advisory Council and also part of the CILRIF working group, and serves on the UN's Joint Sustainable Development Global Fund for Blue Economy Investor Advisory Group. He also serves on S&P Global Ratings ESG Leadership Council, the steering committee of the Orange Bond Principles, Fannie Mae's Green Rental Housing Task Force, and Sustainalytics Investor Committee. Finally, we have Jorge Gastelmindi, who is the Global Policy Director at Adrian Ash Rockefeller Foundation Resilience Center based out of Arlington, USA. He leads the policy and finance pillar at the center, overseeing the policy and finance solutions across the portfolios of interventions. He's previously worked with the TNC, the Nature Conservancy, and also served as chief advisor and negotiator to the government of Peru, leading the adoption of the Paris Agreement in the government's dual role as UNFCCC's COP20 presidency and co-chair of the Green Climate Funds Board. With that, I would like to invite Jorge for his presentation, but I'll just take a minute to introduce myself. I'll be your moderator and facilitator today. I'm Abhishek Dhawan, Sustainable Finance and Partnership Specialist at UNCDF based out of New York. And also, I have been working with all the several partners in this conversation on the CILRIF working group. With that, I'll request the organizers to move to the next slide for Jorge to do his presentation. Jorge, the floor is yours.
Thank you, Abhishek. And thank you so much for both UNCDF and ICLEI for the invitation. So we have little time today, so I'll go directly into topic. This week we will be launching a paper called The Real Burden of Extreme Heat. And I just wanted to share some highlights of that paper, which hopefully will provide a bit of framework on the discussions around disaster risk finance and insurance. So next slide, please. Why focusing on extreme heat? I will invite you to visit our website. I'll mention that at the end of my presentation. But extreme heat is a #1 killer of climate impacts around the world. It has immense impacts, economic impacts. We have made an analysis last year with Vivid Economics and McKinsey. The impact on the U.S. economy for one single year is $100 billion only on lost productivity. So one dimension, economic dimension, has that impact, economic impact. And we just released last week during New York Climate Week a report of 12 cities, half from the global south, half from the global north, with the same kind of analysis in terms of loss of productivity. And the impacts on cities is immense on that single economic aspect. The amount of people that are going to be exposed to lethal heat waves by 2050 is going to increase 14-fold over the next 20 years. And so the cases are just, starting to become more obvious in terms of the impact on health, on both mortality and morbidity, and the impact on infrastructure as well, both, in terms of, for example, in this case, airplanes cannot fly after 120 Fahrenheit degrees. So those are things that are misappreciated, misunderstood, and certainly underaddressed. So the idea of our center, the work that we're doing, is to try to address that. And one of the elements is through disaster risk finance and insurance. So next slide, please. The understanding of, as I said, the misunderstanding of extreme heat goes across the board, both in terms of impacts on health on people, but also in terms of the impact on economic impact. And so usually what we see and what we have seen in terms of responses to extreme heat is, averting immediate, the top of the iceberg, the tip of the iceberg, averting immediate threat to health, cooling stations, water bottles, access to water, and usually those are small scale and low cost. But there's a set of wider impacts that will require bigger economic investments to address those. And I won't go into details here. We don't have a lot of time today. But the point here is that in order to think of impact from a climate-related hazard, we need to think holistically, and that will require rethinking the way we build and plan infrastructure, the way we organize as communities in terms of addressing that. And also certainly the way in which private sector could play a role, both in terms of addressing health from their employees, but also through the health system, both public and private, and the way we're looking into this climate hazard and the impact that it's creating. Next slide, please. So with that, the report that we're going to be releasing this week, you will be able to find it in the website link that I put in the left lower side of the slide. But the contribution that we're putting on the table is how any decision maker or a practitioner could actually start thinking of what are the best fit for disaster risk finance instruments, including insurance, on addressing this particular climate hazard extreme heat. But I would venture to say that this same approach could be applied to other climate hazards. So at the end of the day, the idea is that you can understand better the context in which a community is placed, both in terms of social aspects, but also political aspects. And through that, start doing a process, as you can see here, starting with money out. Money out is the systems that are in place to put the resources, financial resources, out to the public. And so the first steps actually help you start identifying what is that context and what are the systems in place to actually allow for that money to go out. Once you have clarity on that, then you move into the money in, which is the instruments that would allow for the beneficiary, potential beneficiaries or users of those resources to actually access those resources. So you start going deep into the tailoring of the mechanisms, the financial instruments and mechanisms that actually could address that issue. And at the end, you have an analysis of the processes and the process that you will need to put in place to actually make that happen. I'm out of time, and I want to respect the other people's time. But I would just invite you to visit that website, 1billionresilient.org, and look at this paper that's going to be launched later this week, but also the work that we're doing on extreme heat. So thank you so much again to ICLEI and UNCDF. Abhishek, much appreciated.
Thank you, Jorge, for this presentation, and I'm sure people will reach out. I will now hand it over to my colleague from ICLEI to present the UIIF project and the 7-stage roadmap process. Over to you, Anina.
Thank you so much for that introduction, and good day to everyone. It's a pleasure to be speaking with you all today. My name is Anina, and I've been supporting the Urban Infrastructure Insurance Facility, UIIF project within the Resilient Development Team at the ICLEI World Secretariat. And I'm very excited to be introducing and sharing with you a little bit of what we have been doing with our ICLEI regional offices in South America and Mexico, Central America, and Caribbean, as well as our funding partner, KfW. So we can just jump right into it. Next slide, please. So to begin, we first need to establish some context for the region in which the project is being set. As we know, cities are often at the front line of response to climate-related hazards because of their geography, often in low-lying coastal areas, and their concentration of population, infrastructure, and assets. And the Latin American and Caribbean region is no exception here. Indeed, it is considered the world's most urbanized and socially unequal region, experiencing large shifts in population from rural to urban areas in just the last few decades. Moreover, it's anticipated that more than 100 million people in this region are estimated to live in urban slums. And this is in addition to the fact that limited economic development and more frequent extreme weather events have made existing risks worse and uncovered even more new risks. Such hazards like flooding, earthquakes, and hurricanes are causing damage to infrastructure and hindering people's quality of life. And climate change is, as we know, only exacerbating the intensity and the frequency of this. All too often, this means that the people most vulnerable to the impact of natural disasters are those at the intersection of poverty, gender, disabilities, and ethnicity. In addition, economic losses from climate change related hazards are trending upwards, and at the same time, the global insurance protection gap is widening, meaning that we are collectively underinvesting in climate risk protection. And this is particularly concerning when we factor in that 85% of climate finance is destined to mitigation projects. Next slide, please. So with an estimated 70% of Latin American and Caribbean cities at risk of experiencing natural disasters that can critically affect residents and infrastructure, addressing the gap in global insurance protection remains a key issue in the area, especially since few losses are insured. Latin American and Caribbean cities can play a key role in closing the global protection gap by acting as insurance consumers and funding risk reduction, as stewards of risk reduction and management through policy and planning, and as promoters of knowledge about risk and insurance provision about the urban ecosystem. Insurance can increase risk awareness, provide incentives for risk mitigation, and support economic growth and capital mobilization. Furthermore, urban insurance can help balance a city's budget following a damaging disaster. Yet adoption of these products in the Latin American and Caribbean region remain low, as insurance premiums and market availability are the two biggest barriers to a city purchasing natural disaster insurance. But thankfully, there is a project that is trying to address this. Next slide, please. So the UIIF project aims to provide city-scale insurance protection against natural hazards by covering critical infrastructure and vulnerable segments of the population in these cities. The overall idea of the project is to develop tailor-made insurance coverage for 10 cities in the region by 2025, covering at least 7.5 million vulnerable people. Cities will undergo a risk assessment of their critical assets and areas, which will inform and tailor insurance coverage products to their key assets, areas, and specific needs. And so based off of the city's unique context, these insurance products will define the groups of people that are considered vulnerable and how each city will disperse the funds to them in the aftermath of a natural disaster. Next slide, please. Through these products, cities' natural disaster risks are transferred to a cumulative portfolio, also known as a risk pool, that leverages economies of scale and risk sharing between insurers and reinsurers, which will reduce the overall premium costs for participating cities. In this way, a risk pooling mechanism groups together multiple contributors to diversify risks and spread the financial costs among them. The project's risk pool is funded by said cities with subsidies from the UIIF project for the first 3 years. And following an extreme weather event, the insurance provider will ensure rapid delivery of financial resources via quick payouts to participating cities to rebuild critical infrastructure and help the residents identified as most vulnerable cope with the impacts. And so here on the right-hand side of this slide, you can find an image of what a risk pool entails for cities, as opposed to obtaining coverage on their own. Next slide, please. Ultimately, the project aims to better equip and prepare cities to cope with climate impacts, striving to maintain key services, business operations, and quality of life for residents. But more specifically, by transferring risk to third parties, cities can relieve their balance sheets from the burden of directly covering losses following a natural disaster. And then from this, the relieved resources can be directed to prepare and improve critical infrastructure and support the most vulnerable groups of residents. As an additional advantage to being involved in the project, legal and technical consulting services will be provided to support and enhance city officials' technical capabilities and knowledge, and embolden cities to develop risk management policies. So if there's anything to be taken away from this project presentation, not only will the UIIF project facilitate access to insurance, but it also seeks to close the gap between cities and the insurance industry, and more importantly, also bridge the gap on information and data accessibility regarding hazards and vulnerability. So the question is then, how do we get there, and what does this roadmap look like? Next slide, please. So together in partnership with our ICLEI regional offices and KFW, we have illustrated a 7-stage roadmap to screen the capacities of cities and connect them to broader policies for risk management. This particular slide is aimed at conveying a message behind the project and highlighting that it has a logical sequence. But more specifically, cities need to follow stage 1 through 7 in order to successfully complete the project. And each of these stages entail a specific outcome. In this way, the cities are not going to advance if they don't complete each step. So for example, cities cannot advance to the second stage to sign a cooperation agreement until completing the first stage, where a letter of intent needs to be signed based off of 20 city fact sheets that we are constructing. And these city fact sheets represent collected data from our regional offices, both from desk research and semi-structured interviews with city officials. And they serve as a first screening of selected cities. Jumping to stage 3, a quantitative risk assessment will be developed, and cities will acknowledge that they have received this study, and hence they will sign a compromise to manage and reduce the risk that has been identified and quantified by this study. With the quantitative risk assessment, cities can then begin deciding how much risk they want to transfer when designing the product term sheet for stage 4. And so at stage 4, the specifics of the insurance are defined, and cities will make commitments on resource allocation for acquisition. At stage 5, the premium subsidy is defined, and the subsidy contract is signed based off of the product term sheet. This will detail how much premium cost, how much the premium will cost, and how much the UIIF project will relieve the city from paying the full extent of the premium in the event of an extreme weather event. At stage 6, cities receive the insurance product details and are formally requested to purchase the insurance premium. And then finally, stage 7, the premium subsidy is received by cities. And in the event of a natural hazard, cities will disperse their premium share, and the UIIF will disperse the subsidy share. And next slide, please. So as previously mentioned, the UIIF project will provide subsidies to the cities for the first 3 years, but the idea is to create long-term success and for participating cities to become pioneers in urban insurance that will set an example for other cities in the region for similar uptake and favorable outcomes. And so all in all, the UIIF project intends to help cities acquire insurance, but also enable and connect them to broader policies for risk management. And with that said, that concludes this UIIF presentation. I would like to thank you so much all for your attention. And if you have any questions, feel free to leave them in the chat box or contact us through the UIIF email address. Thank you.
Thank you, Anina, for a very enlightening presentation. It was very helpful to sort of see the work that ICLEI is doing in Latin America with UIIF. And you find it's quite complementary to CILRIF that we've been working on. So thank you very much for the presentation. Just in terms of logistics, before getting into the next section of the slide, may I request all the participants to put the name of their organization that they represent by clicking on the 3 dots against their name and adding the name of their organization before their names. It will be very helpful for us to understand who is in the conversation today. With that, we'll get into what CILRIF is about, climate insurance linked resilient infrastructure financing. Next slide, please. So as we know, and this is why we are here, is that we've been seeing more and more climate events happen across the world. And as a result, the impacts of climate change are here and now, and they are crippling, expensive, and global. And what we're talking about with CILRIF is and also UIIF is isn't prevention better than cure? Next slide, please. So what are the barriers that CILRIF is addressing? The first barrier that CILRIF addresses is lack of liquidity for cities when they get impacted by a climate event, which essentially means for the cities, especially in developing countries, reallocation of resources that impacts future development efforts. The cities, mostly in developing markets, but also in other parts of the world, face in general barriers to financing. And finally, because there is lack of financing or the cost of financing is very high, there is limited investment going into resiliency interventions when it comes to planning of infrastructure investments. So CILRIF intends to offer long-term insurance that can promote resiliency, and I'll get into how the CILRIF approach works in the next slide. Next slide, please. So let's take an example here where a city has set aside $1 billion for investment in infrastructure. This is a purely hypothetical example. In the current scenario, it gets impacted by a climate event and results in $350 million of losses and damage, which essentially means that the city will use the resources that it has set aside for development in order to recover from such a climate event. And as a result, they are left with only $650 million in planned infrastructure. It also means that it is more difficult for cities to invest in resiliency, and they get caught in this vicious cycle where they have to either raise debt to invest in infrastructure or take funding away from other intervention they are looking to make. Finally, coming to insurance, as we have seen in more and more parts of the world with more climate events happening, the climate insurance products that have been available, and there are very few available in the first place, especially for city governments to access to protect themselves from climate events. There are at best 1 or 2 or 3 year kind of products available, which are not incentive enough for cities to invest in resiliency. Next slide, please. So what happens when a city looks at the concept of CILRIF in a more holistic manner? Using the same example, assume the city were to buy an insurance product that cost them $35 million over 10 years with a fixed premium. When a climate event happens that costs the city $350 million, they immediately get paid by, and this is a very simplistic example. We can make it complex, but for the purpose of this discussion, we felt it's important to keep it simple. The city gets paid immediately by the insurance cover the $350 million that they need to recover, which means that there is no budget reallocation that happens and future development plans can stay on the course. However, what we need the city to do is, based on the climate event that the city is most exposed to, they need to commit to investing in infrastructure, which is resilient. So they need to, if the risk was, say, flooding, they need to invest in interventions that the city has identified, which will make the city less exposed to the risk. In this example, say the cost of that is $250 million of investment in resiliency intervention. However, with the CILRIF approach, what happens is once the city has invested that and built that infrastructure, it results in lower insurance premiums. And in this example, it goes down from $35 million to $25 million. That's $100 million in premium savings over 10 years. What we also believe will help is the fact that the city is investing in resiliency and buying insurance. We expect that the cost of financing for the cities to go down. And assuming the city was borrowing all of the investment that it is making into infrastructure, if the cost reduces by 200 basis points, that's additional $75 million in savings. So if you could go to the next slide, we can summarize what this example looks like. City that is adopting the CILRIF approach will be able to partially, if not fully, finance investments into resiliency through potential savings in cost of financing and reduced premiums from insurance, while receiving protection and liquidity at the in case of climate events. Next slide, please. So what are the different phases of implementation of CILRIF as an approach? We did our first phase between September 20 and Jan 22, where we did a lot of research and analysis and how this product could work. We are in phase 2, where we are piloting with a couple of cities, and Makati City, which will be presenting later today, will talk about their experience with CILRIF. And finally, we intend to start the scale up, which is where we hope some of the city participants today would be able, this sounds interesting for them to be part of this process. Next slide, please. The CILRIF approach is expected to have sort of longer term benefits for cities in terms of SDGs. Obviously, it is linked to SDG 9, 11, 13, but also 6 and 8, leading to cities becoming more financially and climate resilient, which means better jobs and employment, but at the same time, better infrastructure. And of course, it protects the cities from climate events. Next slide, please. This is the list of ecosystem actors who've been sort of part of, and we are very fortunate to have some of them here today, where voluntary participants from these organizations have been part of the conversations over the last 2.5 years to streamline how this approach could look like and move it forward. Next slide, please. So with that, I would like to invite Adam Sobel, professor of Columbia University, who's also been very kind enough to contribute to the CILRIF working group, to share his experience, but also speak about what he's seeing as a climate scientist in the space, and why such an approach is, in his view, important for cities to consider. Thank you so much, and I invite you, Adam, for the conversation.
Thank you, Abhishek, and thanks to ICLEI for hosting this event and including me. It's been my pleasure and honor to be involved in this process with Abhishek and the rest of the team that he just mentioned over the last 2+ years. So I'm a climate scientist. I study extreme weather events and how they're related to climate change. And so I look at how extreme events are changing. And a lot of this ends up being about explaining uncertainties. There's a lot that we know, but there's a lot that we don't know. And we have to understand both of those things to know how to manage climate risk. So some kinds of extremes are definitely changing for the worse, and you've heard a little bit about some of it already. Extreme heat events are surely becoming more frequent and intense. The same is true in most places of extreme rain events that cause freshwater flooding, and sea level rise makes coastal flood risk more severe. For example, what we just saw with Hurricane Ian in Florida. Hurricanes, which I spend a lot of time studying, including in some work in collaboration with players in the insurance industry. Hurricanes are getting stronger. We have considerable evidence for that. The winds are getting stronger, the rains are getting stronger. We don't know in general on the planet Earth if hurricanes are becoming more frequent. So far, they don't seem to be on the globe as a whole. I have in case anyone's interested, I have a piece today that's about how the Atlantic in particular, where the US and Caribbean are most at risk, does seem to be disproportionately increasing. But overall, some of our climate models suggest we're going to have less hurricanes in the future, although others suggest more. So there's a lot we don't know as well as what we do know. But when you consider risk as a whole, and you take into account together these kind of what we call epistemic uncertainties, I mean, the things unknown unknowns as well as the known unknowns, which is like, that we never know when the storm is going to happen, even if we know what the probabilities are. Overall risk is increasing, certainly to cities. I don't think that's news to anyone here, but of course we still have to live in cities. The world is urbanizing. So these risks have to be managed. And as Abhishek just explained, cities shouldn't have to do it alone. There's a potential and even a need for risk transfer mechanisms, especially to finance adaptation and resilience measures to make cities safer. So the right time scale to do this, and I really, really believe this, and this is why I've been eager to volunteer my time for this effort, the right time scale for risk transfer and insurance to support adaptation and resilience is the one that's matched to the problem. So climate change is a long-term problem. It's happening over decades. I mean, of course, we're seeing impacts now, but the timescale over which things change is decades and longer. And so the risk transfer should be timed to that. I think it really, it's clear that that insurance should be long-term, even though it isn't now. Most products, as Abhishek said, are 1, 2, maybe, you know, that kind of time scale, 1 or 2, maybe 3 years. It should be 10, 20, because those are the timescales over which the risk is evolving and over which they manifest, because there's not an extreme event every year, they're every so often. And so there should be some stability in the way we manage the risk, and they should support the adaptation and resilience investments, not be a substitute for them. So that's the idea of CILRIF. Now, to do this, we need to model the risk in order to know how to price this. And there's challenges here. The insurance industry is not used to doing it, in part because it requires modeling climate change, which is a new thing. But I believe we can do that. I'm convinced we can do it, and we can do it not just with you know, the best science, but also ethically and transparently. This is a really exciting challenge that I'm happy to be a part of. The timescale is not so long, you know, that we're talking about, that it requires resolving the really long timescales, you know, that are what's going to happen in 100 or 200 years. 10 or 20, I believe we can do, and we should do. So, I mean, the reason, you know, this may seem like a foreign or a strange idea because it doesn't exist yet. But I, as a scientist, am completely convinced that it should exist and that it's a good idea for cities. So I'll stop there. Thanks for your attention.
Thank you very much, Adam, for that intervention. I would now like to go to the next slide, please, which is Stephen, to share his view of what he sees in the CILRIF approach as an investor. Over to you, Stephen.
Thank you, Abhishek. Appreciate it. And thank you to CILRIF and ICLEI for the opportunity to speak. I have been fortunate enough to be working on the CILRIF project for the past couple of years, trying to provide an investor view to the product and ultimately to how an investor would utilize such product or want to look at it as an evaluation kit. I think one of the things that is becoming more and more obvious as the days go by and that the investor community is recognizing is how much climate is financial risk. Climate risk is financial risk. And such that there's an opportunity for investors to evaluate products like this in a way that could be beneficial for both the macro analysis as well as the micro analysis. And I say that from the perspective of being able to evaluate not just risks inherent to investing in a particular entity, whether it be a public or a private entity, but also in the evaluation of investing in entire countries or sovereign analysis, especially those that are in the global south that are more exposed to climate risk and climate change, and that may be preventing additional capital to be invested in those particular countries because the risk of climate change is so unknown at this point in time. So it feels as though this is an opportunity to try to create a product that puts in place the opportunity for investors to get a better handle on exactly the approaches that are being taken and the actual investments that are being made to improve climate resiliency, which therefore could provide additional stability to economic prospects for that particular country, and then therefore every entity that operates within that country. I think it's also an important product because in some ways it allows for the pricing of new or different risks in the marketplace that currently aren't being placed within the market. So in the traditional catastrophe market, we do have pricing available that you can see in a transparent way from various catastrophe bonds. However, they're not viewed in the same way, I think, as a more holistic approach to pricing of climate. And as such, I think this particular product is one that will allow for a broader view of climate risk and effectively a pricing of it, which can then be translated to other countries or sovereigns, and therefore the underlying entities that operate within those countries, based on a particular mix of risk that may not be currently priced in the market. And that particular focus, I think, provides tremendous value because it's going to allow for, again, a differentiation of investment and a differentiation of potential risk in a manner that's currently not priced in the market, and could be therefore very catalytic in going forward to provide additional capital to countries, especially those in the global south and those that are extremely, exposed to changing of climate. And it also, I think, provides the market as an investor an opportunity to start to evaluate new and different opportunities for investment that currently aren't being considered because climate change is such an unknown, and how that ties into financial unknown. So ultimately, what we're trying to do is provide an opportunity for investors to start looking at individual transactions, both at the micro or individual issuer level and the macro level at the sovereign level, that they're currently not willing to even engage in or look at because of unknown related to climate. And this, I think, is a real great first step in trying to provide a framework and a pricing mechanism in order to bring more investors to the table to provide the capital that's currently needed in the developing world, especially those that are most exposed to climate change. Thank you very much.
Thank you so much, Stephen. Without further ado, I'll get to Sam to present his slides for the next few minutes. Sam, if you could try to speed up as we are running a bit short on time, but it's over to you. Thank you so much.
Great, thank you very much. So, well, nice to meet you all. My name is Sam Lynch. I'm a program coordinator at Miyamoto International. And Miyamoto is an engineering company. We do multi-hazard risk. We work around the world, and we focus on critical infrastructure and the resilience of such infrastructure, ranging from, bridges, roads to affordable housing, as well as commercial properties. And so, next slide, please. I just have one very quick slide that our team prepared. This was done by one of our engineers, and one of the key parts of our work is looking at the cost and benefit of incorporating different resilience measures, and what that impact has on the infrastructure assets that are looked at. So as we can see in this table, we prepared a very, very high level overview of flood resilience measures for road and drainage infrastructure in Makati. And what this table is intended to show is, on the left column, you can see the project phase, which shows how it's very important to incorporate resilience in all phases of the planning and maintenance of an asset. So we can incorporate very, very basic resilience measures of varying levels of complexity. And then these can have, in turn, very influential outcomes on the life cycle of an infrastructure asset and the economic benefits that come from incorporating resilience. So as early as the planning and design stage, things like nature-based solutions can be included to prevent the adverse effects of heavy rainfall and flooding. And also very key to this approach, and what is very common, is looking at flood hazard maps, real-time monitoring networks, emergency warning systems to expedite recovery, mitigate damage, and really facilitate quick recovery and rebuilding after a natural hazard does occur. And some of the resilience measures we've identified that have an especially a high cost benefit are in the design and construction phases, using, for example, for roads, stronger and thicker asphalt, moisture resistant material. These are pretty simple solutions that can have very positive economic benefits in the long term, and pretty low costs to incorporate them. So these kinds of tables will need to be done for many more kinds of assets, many different hazards, many different cities. And it's really just a starting point to look at how we can begin to conceptualize which engineering measures and which design measures are going to give us the most benefit economically, but also promote resilience and the safety of humans using these assets. And that's all for me.
Thank you, Sam, for that very fascinating slide. Just for the participants, the objective of the slide was really to show that there are resiliency interventions which are possible in and how the cost benefit analysis done early in the process would be very helpful. We'll talk more about it in the breakout session as we go into the McCarthy conversation later in a few minutes. But before going into that, we have a poll that we would like to open up for all the participants who are there. During this poll, you will be asked a few questions which will help us assess sort of the need and how all of your different cities are thinking about climate change adaptation. We would request you to let us know if you are comfortable sharing your names and organization which might be asked. So if you give us the consent, that will help us to reach out to you later. But with that, I'll pass it on to the organizers to share the poll. We'll have about 10 minutes for this. Feel free to use the Slido code here on your screen, the QR code, to download the application, and which will allow you to sort of respond to the questions. So the first question is, what is the main climate risk that your city faces? And we've given a few options. Feel free to sort of use the link in your chat as well now. So please download that or click on that link and put in the responses. We see about 60 plus people today in this conversation right now. So request you to please respond to us. It will help us understand the risks that global communities are facing and also assess what can be done about it. Next question, please. This is to understand what level of infrastructure that the cities have faced which have gotten affected by past climate events. Select all that apply. Next question, please. This question is more to understand if the city has been thinking about, and if the I think one interesting thing that we've seen is that many times the information might be available but might not be available with people who need it. So the question is, can you quantify the amount of costs and expenses that the city has incurred to rebuild, restore, or put into place safety infrastructure affected by climate event that the city wanted to protect against? And if you have a sense of what that number looks like as well. Our hypothesis is that we'll receive the answer, information not available from most people. But we'll see how that looks like in a few minutes. Next slide, please. Next question, sorry. This question about what kind of projects have been developed or implemented by the city so far to increase their resilience to climate events. These are just some examples with the intention to understand if cities have actually been making active investments into resilience building in their respective geographies. Next question, please. This is to understand whether the cities have a comprehensive public infrastructure plan or resilience investment plan. If not, this is where CILRIF would like to, and I'm sure UIIF would like to speak with you to see what can be done about it, what kind of support can be provided to US cities participants. Next question, please. Could you please identify the critical in public infrastructure in high risk prone areas that you have identified? Again, the objective of this question is to understand what level of risk exists in your respective cities, what kind of infrastructure the city is responsible for, etc. Next question, please. This question is to understand what kind of organizational structure exists in the city. So does the city have dedicated local government emergency response personnel or Department of Public Works that participates in developing, updating the comprehensive public infrastructure plan? We'll see in the sort of breakout session how this could be an important element, and Ms. Merlina from McCarthy might want to share some experiences at that point. So we would urge you to, if these questions are important for you and you would like to know the answers, we look forward to sort of having you in the breakout sessions as well. Next question, please. We just have a couple of more. So how does the city finance its public infrastructure and resiliency projects? So as we talked about, CILRIF is about climate insurance, but it is also about helping cities get access to financing, helping cities reduce cost of financing. We need to first know how does the city finance its public infrastructure and resiliency projects? Through tax revenue or public capital markets or other means of financing? Next question, please. And this is to go a little deeper to understand if the city has ability to borrow from commercial lenders, or it can issue bonds, or it is mostly supported by the provincial government. Next question, please. And then it is also very important if the city is allowed to buy climate insurance or not. This is indeed the last question. So with that, we'll stop here. We'll briefly show the results, but we'll discuss the results more in the breakout session on CILRIF, which is where we will talk about what the results were, and then the interventions from McCarthy, and do a bit of discussion with the city participants. So may I request the organizers to briefly share the results to the broader group, and then we will talk more about the results. Wow, that's a lot. 2/3 of the participants. So most cities can borrow as well. Next question, please. It's on expected lines. Tax revenue is what is going towards financing. Next question, please. Wonderful, that's great news. Okay. Most cities don't seem to have comprehensive plans, so it's something we can discuss about in the breakout session. Very interesting. Next question, please. This is as expected. Looks like most cities might have available information, which is what we have learned, but it's also interesting to see that over 8% of participants said that the cost of recovery was more than $200 million. Thinking about it is just amazing, the amount of savings the city can have if they had the right kind of coverage. Next question, please. And a lot of public infrastructure seems to get affected by such climate events. Last but not the least, the first question. And it looks like floods and heat waves are very important. So Jorge, if you are still around, I think it's important, the work that you're doing, how important it is for the cities to think about heat waves, apart from the storms and the floods, which appear to be the more common climate risk that the cities are facing. Well, with that, I'll hand it over to the organizers to take us into the breakout room. Hello, everyone. Welcome back to the main session. I think we still have some colleagues joining. Okay, well, looks like everybody is back. So this is the last 10 minutes of this conversation, and I wanted to open the floor for any questions or comments. And then we have a short set of couple of questions through a Google form that we would like to request you to fill. But before going into the last few minutes of the session, I'm opening the floor for any questions that people might have. So please raise your hands for any of the panelists or speakers today. Please raise your hand and you will have the floor. Jorge, do you want to go ahead? Go ahead, please.
Yes, Abhishek and Anina, this is just an invitation. We've been in contact. My other hat, as in addition to Atlantic Council, is I work with the UN high-level climate champions with Mahmoud Mohildin and Nigel Topping at the UNCCC. And we've been in touch with both you, Abhishek, from UNCDF, and also with Anina ICLEI, with David Jacome. We're going to be doing launching a campaign at COP27 to elevate the profile of demonstrations projects and initiatives such as yours, both CILRIF and UIIF. And so this is an invitation to everybody to pay attention to that. We'll be delighted to have that effort coming together as a common front across the board. So thank you.
Thank you, Jorge, for the invitation. Any other comments or questions for the panelists or speakers? If not, I'll request my colleague Karen to post in the chat a very short Google form survey for the participants to briefly fill it as a summary of this discussion, and whether they would like us, either the CILRIF team or the UIIF team, to be in touch. And there are just basically two questions: your name, organization name, and title, as well as whether you are interested in either CILRIF or UIIF interventions. This will just help us reach out to you if that's something of interest. So with this, I would like to thank all the attendees and speakers for today's conversation and the opportunity to present our approaches. It was a pleasure having you this morning, afternoon, evening, and look forward to staying in touch. Have a good day or rest of the evening, wherever you are.